Imagine waking up in the morning, checking your phone, and realizing that while you were dreaming, companies like Coca-Cola, Apple, or Johnson & Johnson literally paid you just for owning a small piece of their business. That's the magic of dividend stocks. They are one of the simplest, yet most powerful ways to build lasting wealth. And here's the secret: you don't need to be a millionaire to get started. You don't need to time the market. You don't even need to be a financial genius. What you do need is patience, consistency, and the right strategy. What are dividend stocks? Alright, let's start with the basics. What exactly are dividend stocks? Think of it this way: when you own a stock, you own a piece of a company. Some companies take their profits and reinvest all of it back into growing the business. But others, especially stable, profitable companies, decide to share a portion of their profits with shareholders. That profit-sharing payment is called a dividend. For example, let's say you own 10 shares of Coca-Cola, and Coca-Cola pays an annual dividend of $1.80 per share. That means you'd get $18 every single year, just for owning those shares. It's like rent money, but instead of owning a house and dealing with tenants, you're collecting money because you own shares in a company. And here's the kicker: many of these companies don't just pay dividends once a year. They pay them every quarter, 4 times a year. Some even monthly. Dividend stocks are essentially income-generating assets. They pay you cash regularly, no matter what's happening in the economy. That's why retirees love them. But here's the mindset shift: you don't have to wait until retirement to benefit. If you start early and reinvest those dividends, the snowball effect can make you rich. Why dividend stocks build wealth long-term? So why are dividend stocks one of the best wealth-building tools out there? 3 reasons: stability, passive income, and growth. 1. Stability. Most dividend-paying companies are big, established businesses. We're talking companies that have been around for decades, even centuries. These are household names that sell products people use every single day: Pepsi, Procter & Gamble, McDonald's. These businesses don't just disappear overnight. 2. Passive income. Imagine building a portfolio where every 3 months, you receive deposits into your account, without lifting a finger. That's income you didn't trade time for. It's not tied to your job. It's money working for you. 3. Growth. And here's the big one: many dividend stocks don't just pay dividends, they actually grow them. Every year, they increase how much they pay you. This means your income grows without you having to buy more shares. That's called dividend growth investing, and it's a game changer. The power of compounding dividends. Now, this is where the magic happens. Compounding. Here's how it works. Let's say you invest $1,000 into a stock that pays a 4% dividend. That means at the end of the year, you get $40 in dividends. Now, you could spend that $40, or you could reinvest it, buying more shares. Those extra shares will then also start paying dividends. So next year, instead of just $40, maybe you get $45. The year after, maybe $52. And on and on. Over time, your dividends earn dividends, and the snowball gets bigger. Let's look at an example. If you invest $500 a month into dividend stocks with an average 8% return, after 30 years, you wouldn't just have the money you put in. You'd have over $750,000. And much of that would be from reinvested dividends compounding over time. This is how ordinary people with average incomes end up with millionaire portfolios. They let time and compounding do the heavy lifting. The earlier you start, the bigger the snowball. How to pick the right dividend stocks. Okay, so how do you actually choose dividend stocks? Not all of them are created equal. Some pay huge dividends but are actually risky. Others pay smaller dividends but grow consistently over decades. Here's what to look for. 1. Dividend yield. This is the percentage of the stock price that's paid as dividends. For example, if a $100 stock pays $4 a year, that's a 4% yield. A healthy range is usually 2% to 6%. Be careful of yields that are too high. They might not be sustainable. 2. Payout ratio. This tells you how much of a company's profits are being paid out as dividends. If a company pays out 90% of its profits, that's risky, because if profits dip, the dividend might get cut. A safer payout ratio is usually under 60%. 3. Dividend growth history. Look for companies that have consistently raised dividends year after year. These are often called dividend aristocrats, Companies that have increased dividends for at least 25 years straight. 4. Financial health. Check if the company is profitable, has manageable debt, and operates in an industry with steady demand. You don't want to rely on a company that's one recession away from cutting your income. Some popular dividend stocks investors love are companies like Coca-Cola, Procter & Gamble, Johnson & Johnson, Pepsi, McDonald's, Microsoft, and Apple. These aren't just companies. They're brands that have stood the test of time. Dividend growth investing strategy. Instead of chasing the highest yields, you focus on companies that consistently grow their dividends. Think of it like planting a tree. You don't want a tree that gives you tons of fruit right away but then dies in 2 years. You want a tree that grows stronger every year, producing more and more fruit for decades. For example, let's say you invest in a stock that currently pays a 3% dividend. That might not sound huge. But if the company grows its dividend by 8% every year, in 10 years, your dividend income could be double what it is today, without you investing another penny. This strategy is less about get rich quick, and more about get rich surely. It's how you create a rising stream of income that grows faster than inflation and lasts for life. Reinvesting dividends versus taking cash. So once you start receiving dividends, what should you do with them? You have two options: reinvest them or take the cash. If you're young and still building wealth, reinvesting is the smartest move. Most brokers even offer a dividend reinvestment plan, DRIP, where dividends automatically buy more shares. This accelerates compounding like crazy. If you're older or living off your portfolio, you might choose to take dividends as cash. This can cover your living expenses without having to sell your investments. That's why dividends are so powerful. They can fund your lifestyle in retirement, while you keep your wealth intact. Risks of dividend investing and how to avoid mistakes. Now let's be real. Dividend investing isn't magic. There are risks. Dividend cuts. If a company's profits fall, they might reduce or eliminate dividends. This usually happens with companies that pay too high yield. Chasing high yields. A stock paying 12% dividends might sound amazing, but it's often a trap. High yields can signal a struggling business. Inflation. If your dividends don't grow, inflation can eat away at your purchasing power. That's why dividend growth stocks are key. To avoid mistakes, focus on strong, stable companies with a history of paying and increasing dividends. Step-by-step action plan for beginners. Alright, let's get practical. If you're ready to start your dividend journey, here's your roadmap. 1. Open a brokerage account. Choose a reliable broker that offers dividend reinvestment plans. 2. Start small. Even $100 a month can grow into something massive over time. Don't wait until you have thousands to begin. 3. Build a watch list. Look at dividend aristocrats, blue-chip companies, and ETFs that focus on dividends. 4. Diversify. Don't put all your money into one stock. Spread it across different sectors like consumer goods, healthcare, technology, and utilities. 5. Reinvest dividends. Let the snowball grow. 6. Stay consistent. Keep investing regularly, through good times and bad. 7. Think long-term. This is not a get-rich-quick scheme. It's a get-rich-sure plan. Here's the bottom line: dividend stocks aren't flashy. They won't make you a millionaire overnight. But they are one of the most reliable, proven ways to build lasting wealth. Every dividend payment you receive is a reminder that your money is working for you. And as those payments grow year after year, you're not just building income, you're building freedom.